Hello and welcome to this week's lecture on gross domestic product. I'm Mike Wenz and I'll be guiding you through the slides. This week we'll examine gross domestic product, which is an important piece of macroeconomic data for analyzing the economy. Gross domestic product, also known as GDP, measures the total income of everyone in the economy, or alternatively can be thought of as measuring the total expenditures of everyone in the economy. It's useful to keep in mind as we think about economic activity that payments made by one side are always received by the other side, and so we can think about measuring people's incomes and measuring people's expenditures in the same way, or in the same place. When we think about the circular flow diagram, which we discussed earlier in the course, we can think about the dollars that flow from households to firms in the form of spending and revenue, circling their way back to households, from firms to households, first in the form of wages, rents, and profits in the market for factors of production, and then translating into income for households. So we can think about measuring GDP in two different ways, by either adding up the income that everybody receives or adding the expenditures that everyone makes. Now, remember that households own factors of production. They own land, labor, and capital, and they sell these things or rent these things to firms in exchange for income, which they use to consume goods and services. Firms, meanwhile, purchase these factors of productions from households and use them to produce the goods and services, which they then turn around and sell back to the household. So everything flows in a circle. The buyers on one side of a transaction are met by sellers on the other side of the transaction, and every transaction has one of each. The circular flow diagram then shows how expenditures flow through the economy. Households spend money in the market for goods and services, which represents revenues for firms, which firms turn into wages, rents, and profits for their factors of production, the owners and workers of the firm, and that represents income for households. The circular flow diagram, we should note, is a simplification of the way the real economy works. In particular, it omits the role of government, the role of the financial sector, and omits foreign trade. But it gives us a way to think about the way that we're measuring income and expenditures in an economy, and extending it to consider these other factors is quite reasonable and straightforward. So let's define what we mean by gross domestic product. Gross domestic product is the market value of all final goods and services produced within a country in a given period of time. So we begin by parsing this and looking at all the different pieces of the definition and trying to bring some clarity to it. Market value. The important thing here is to recognize that things with no market value are not considered. There are a lot of things that contribute to quality of life, or a lot of things that contribute to the production of output that are not measured by GDP. In particular, we don't do much to measure the quality of the environment, and we don't do much to measure things that are produced, say, in the household but are not sold on the market. So there's a different measure of GDP when we consider going to a restaurant that puts all the ingredients together and putting all the and paying for the final restaurant meal, versus buying all the ingredients at the grocery store and bringing them home and putting them together yourself. In GDP, we measure things that are exchanged in the market. We measure the cost of the restaurant meal, but we don't measure things that are produced in the household, such as meals prepared at home. Now, what do we mean by final goods? The important thing here is to recognize that only the value of final output counts. The value of intermediate goods is embodied in the product. That is, when we purchase a car, say for $25,000, we count $25,000 as the value of the good that's being produced. And all of the other intermediate steps don't get double counted. They don't get counted twice. So, for instance, the car manufacturer buys seats from suppliers, or engine blocks from suppliers, or tires from suppliers, and rubber and plastic and the rest of that kind of stuff. But we don't count the intermediate purchases as part of the final good. What we want to measure in GDP is the value of the car, not the value of all the transactions that happened on the way to producing a car. Goods and services. What is meant by goods and services in GDP? Well, it's important to note that both tangible things and services that are provided to end users that represent final goods to consumers are counted in GDP. So, for instance, if we buy a bottle of nail polish, the bottle of nail polish would cost as part of GDP. If we went for a pedicure, the pedicure service provided by the nail salon would also count as GDP. We are concerned in particular with goods that are produced in a current year, not when they are necessarily sold. So if inventory is constructed in a calendar year that we're measuring GDP for, we're interested in the inventory that's produced. So when we measure GDP, we measure changes in inventory from the beginning of the year to the end of the year. We're not measuring when things are sold. So something that's produced in this year but not sold in this year counts as part of GDP, and then next year it will show up in the official statistics as a reduction in inventory rather than an increase in GDP when it becomes sold in the future. We note that gross domestic product represents goods that are produced within the country. That is, they're produced within the borders of the country, whether they're produced by foreigners or by native workers, United States citizens in this case. GDP is concerned with what's produced within the border. This is distinct from gross national product, which is sometimes used, which is concerned with what is produced by Americans, regardless of whether they're operating at home or abroad. GDP is concerned with production in a given period of time. So usually we'll measure GDP for a quarter or a year. So these are things to keep in mind when you think about exactly what it is that GDP is trying to measure. You should note briefly that GDP is a useful and important measure of the health of the economy, but it's not the only way to measure an economy's strengths. There are a number of alternatives that are out there. A couple of popular ones that people sometimes use to measure how well an economy is really doing is the Human Development Index, which is used to evaluate developing countries. In this case, they construct an index that's based 1/3 on GDP, still important, but also uses measures of educational attainment and health outcomes for the population to understand how well an economy is doing. And those other two measures represent 1/3 of the index as well. Some countries and economists have also turned to using what's called a happiness index, and by using happiness indexes or by using surveys or some other measures of people's happiness, they try to measure directly just how well off people are and what their quality of life is, without considering so much simply the material level of consumption that people are enjoying. So while GDP is a very useful and very important measure of the health of an economy, it's not the only one, and it doesn't capture all of the dimensions that we might be interested in.